Welcome to INVEST, your ultimate destination for demystifying the world of investments. Whether it's a job seeker entering the final round of interviews, a baseball player heading to the batting zone, or a US Federal Reserve official looking for signs that inflation continues to fall towards the 2% target, they all want more confidence in themselves. Unfortunately, people have lacked confidence that inflation will cool down this year. Prices have continued to rise longer than expected, and the US economy continues to grow rapidly. As Powell and many other Federal Reserve officials recently pointed out, there is no sufficient reason for the Federal Reserve to cut interest rates in the short term. The futures market has lowered expectations for how many times the Fed will cut interest rates this year, and some economists even think that the Fed will not cut interest rates this year. What is the reason behind inflationary resilience? Although Powell and other Federal Reserve officials insist that current monetary policy is restrictive, America's loose financial environment is a major reason. Looking at the numbers, Powell and other Federal Reserve officials are probably right. According to the Taylor Rule, proposed by Stanford University economist John Taylor in a 1993 paper, the federal funds rate calculated from recent inflation and economic growth data is around 4.75%, lower than the current 5.5%, marking the first time in 10 years that policy interest rates measured according to Taylor's law are in a restricted area. But that's just theoretical. Currently, indicators that measure financial conditions in the real world show that monetary policy is in a fairly relaxed region. The National Financial Conditions Index compiled by the Chicago Federal Reserve is as relaxed as January 2022, 2 months before the Federal Reserve began raising interest rates. The National Financial Condition Index is updated weekly. The index includes 105 sub-indicators, including bank loan standards, differences in yield on treasury bonds, corporate bonds, and mortgaged bonds, the level of outstanding debt and newly issued debt, the US dollar index, and the level of the stock market. However, the Federal Reserve directly controls only one factor: interest rates. Before the Federal Reserve began raising interest rates in 2022, a large number of companies were refinancing to convert short-term debt into long-term debt. Millions of landlords currently enjoy 30-year fixed mortgage rates, lower than what they earn on savings accounts. The steady growth in corporate profits and the investment boom fueled by artificial intelligence drove stock indexes to record highs. Housing prices remain high due to structural supply shortages in the U.S. housing market. With financial conditions in other areas being relaxed, the fact that the federal funds rate is much higher than 5% does not explain the whole story. The strategist at Jefferies said, "We believe that such loose financial conditions will make the data unlikely to have the kind of performance expected by the Federal Reserve, that is, a slowdown in the labor market and a decline in inflation. Private markets, such as venture capital, are an area where financial conditions are less relaxed." According to Terminal AI data, venture capital in 2023 fell to its low during the 2020 pandemic, or even lower, and has been fluctuating horizontally since then. Arjun Sethi, co-founder of Terminal AI, said, "Capital flows are stabilizing, but today companies that receive financing tend to have more stable businesses and have clear profit paths." This may be a healthy shift compared to 2021 and 2022, when investors often check before asking questions. The Chicago Federal Reserve's National Financial Condition Index is as relaxed as before the Federal Reserve began raising interest rates in 2022. A positive index indicates that the financial situation is tighter than the average, and a negative index indicates that the financial situation is looser than the average. Thank you for watching. If you found value in this video, don't forget to hit the like button, subscribe to our channel, and share it with your friends and family. Together, let's embark on a journey towards financial enlightenment.